All right, y'all, this is being recorded. I mentioned this at the beginning of every single webinar, you guys, is watch this again. Whether it's this synthetic long stock or I've done other series on synthetic long stocks as well. But watch another one of these so that these nuances really stick into your long-term memory. Also, you guys drive these webinars through your questions that you ask throughout this event. So it may veer in different directions for different webinars, and other questions might have gotten answered in those that I may have missed in this one. So make sure you watch it again. There's a lot of information coming at you in a short period of time, and if you watch it within a couple of days or a week, you will most likely be able to remember these rules that I'm going to lay out for implementing this stock. This is also going to be very different than some of the other ones I've done. This is really going to be a course on building out a portfolio. A lot of the other ones I'm talking about trading, getting in and out. This is going to be trading in and around a portfolio that we all have. You know, we have one somewhere. You may have a trading account, but you also have a portfolio. Maybe it's a 401k or an IRA somewhere else. That is what we are going to be talking about and hedging some of that stuff as we go through this. So we're going to try and build out a basic portfolio throughout this entire course, and we'll see how it goes, because I'm going to be putting all this stuff into my portfolio as well, and we'll be playing around with it, talking about it in the daily market commentaries as well. So, you know, tomorrow I'll be talking about the synthetic long stock that I put in based on what we come up with in this webinar. Great to see you, Ted. Hope everybody had a happy Thanksgiving as well. Good call. All right, so the synthetic long stock, but let me get a couple of things out of the way real quick. My name is Eric Wilkinson. You may recognize me from mainstream media as the Wolfman. I basically went on there and talked about everything from geopolitical to economic and market analysis. I actually do all of that in these daily market commentaries now. So I talk about the economics and how that impacts the markets, kind of like what I used to do on TV a little bit there. And then I actually started trading in college with a psychology degree and then switched it over to finance. A buddy of mine told me I was perfect for working on the floor of the Board of Trade. So after graduating, that's exactly what I did, is move straight to Chicago and started working on the floor. Jumped into the pits, and I've been trading stocks, financial futures, commodities, currencies, and options on all those products and just about all market conditions. We got to go over this disclaimer really quick, especially because we're talking about implementing stocks into our portfolio, right? I am not a financial advisor and am not here to give you financial advice. What I'm here to do is talk about options, teach you guys all of the nuances that go into these options, and it's really up to you to implement this stuff in your portfolio in your own way, because I don't know your risk parameters. I don't know what's in your portfolios, and therefore I could not possibly give you investment advice. All right. So consider this general commentary, and please remember past performance of any trading system or methodology is not necessarily indicative of future results. All right. Having that out of the way, you can follow me on Wolfman's blog at Twitter. Our parent company is at ProTraderStrat. We also have been pushing a ton of content out on Facebook. So follow us on Facebook at ProTraderStrategies.com. That some of my daily market commentaries are going to be pushed out on there as well. So take a like to that and follow us so you can get access to that. We're doing it on Facebook because it seems like it's getting out to you guys much quicker that way. You guys are able to see that much sooner. And when I'm doing these daily market commentaries, remember, I'm shooting those live, one take, and trying to get that out to you about as fast as I can. So check that out. All right. So this is on the synthetic long stock. What we're going to be doing is we're going to be building something that is going to perform just like a stock. That's why it's synthetic. You can use options to implement a long stock position, and I'm going to show you how to do that. But I know there's a lot of new faces out there, so I want to go over some of the basics and easy ways to remember these Greeks that everybody talks about, some of the things that everybody gets a little bit frustrated about when they start looking at options. It's the delta, the gamma, the theta, and the Vega. Well, I've got easy ways to help you guys remember these and what they do. Delta is the effects of an option premium in relation to the underlying. Delta is data, all right? It's got a lot of different things that go into it. I mean, I'm not going to be able to go over all of them. I have option hacks to help you remember all of that. But it is the first dollar move in the underlying. So if we pull up our trading platform and I go over here and let's just say Schlumberger because it's here. And we go over here and we look at Delta and we have all of our Greeks right along here. So what Delta tells us, all these little numbers, you know, the 0.36, the 0.18, all that means is the first dollar move. So when this underlying goes from, let me pull up my pen here and get this all set up for you. All right, so let's take a look at this. So we're looking at Schlumberger is right now trading at 35.85, okay? So what Delta tells us down here in this column is for every $1 move, either up or down, all right, it's going to affect the premiums over here. So 36 cents, we kind of just draw a line straight over here, 36 cents. So if this goes from 35.85 and now we're at 36.85, so $1 move higher, right? This premium is going to increase from $1.04 on the bid, and it'll basically turn into $1.40, right? So we got $1.40 bid, and on the offer, we're going to be looking at $1.42, all right? So 142, and that's on the dollar increase. Now, if we go as a dollar decrease, so now we're looking at from 35.85, and now we're looking at $34.85. Okay, our premiums are going to decrease by that 36 cents. So we're going to be looking at basically $1.60. What is that? $1.60, or sorry, no, I'm subtracting, guys. 68 cents and 70 cents. All right, so if the market goes down, our premiums will go down by the correlated delta, all right? So for every dollar move, that's how it's going to affect our premiums. Pretty simple. So delta is really data. It also gives us probabilities of being in the money and all of those things as well. But for this, we're going to be talking about really how delta affects the premium. So for every dollar move, that's what the corresponding premiums are going to be affected by. If it goes up by $1, it increases, because you saw that delta number is a positive number. All right, so it's a positive number. So if it increases by $1, we plus the premium. If it decreases by $1, well, then that's a negative, right? So it will decrease those premiums by that corresponding. And then if we go over to gamma, just remember this, with gamma, it's pretty simple. Gamma just goes with delta. So it's the rate of change in delta, but it really, think about this, is it's on the second dollar move. All right, I don't have a whole lot of room there, but all right, so it's on the second dollar move. Delta or gamma goes with delta. So if we pull up the platform again, and I can show you this. So we talked about this on the first dollar move, and I'll just remember, it's going to be the same thing as what we talked about before. The first dollar move higher, we got on the, I'll do $1 move higher. Our premium went from 140, what is it now? It's 143 bid at 10 cents on the offer, 146. All right, so now it's increased 143. Make sure that's clear. So that was the first dollar move. Now on the second dollar move, gamma right here, gamma goes with delta. So you add in that 9 cents. So now on the second dollar move, so on the $2 move higher, it's going to change by now 45 cents, okay? So those premiums are now on that second dollar move. We add that 45 cents to the bid, and now we're getting 188 bid, right? And then 191 offer. Okay, so that's where that second dollar move comes in. We add the gamma to the delta on that second dollar move. Pretty simple, right? Everybody with me so far? How gamma affects delta? It's the rate of change in it. And if it goes up 50 cents, know that this, you're going to have about 4.5 cents getting added into it. So it is incrementally. It just doesn't ping at every dollar, at every full dollar, but you get what I'm talking about here. It goes up by $1. Our premium goes to that. The second dollar move, now our premiums are going to look like that. And vice versa on the downside, it would be subtracting. Gamma still adds into that. Gamma still goes in there, and on the second dollar move lower. So if we had a down move by $2, then it would decrease by 45 cents on that second dollar move. All right. So gamma still goes with delta. It's going to affect that on the second dollar move. So you can kind of start figuring what your pricing is going to do in and around your underlying on those option strikes. Okay. Now theta is the thief. All right. So an easy way to remember theta, it's just a thief. They call it the impact of time on the premium. Well, we used to call it on the floor, it's the thief in the night that would come and steal your premiums, right? Because we're looking at this all as from a positive, market moves up. Theta is always negative though, all right? So every day that goes by, 2 cents is coming out of this, all right? And theta gets more aggressive the closer we get to expiration. Sorry, right here. Theta gets more aggressive the closer we get to expiration. Way out here in time, we would probably be looking at maybe a penny or something like that of theta coming out of these markets. So you can see, starts out way out, 200 days out, it's a penny. The closer we get in 45 days, it starts increasing to 2 cents. And then, once we're inside of like 15 days, it starts really precipitously picking up. As a matter of fact, theta in here is, a couple of days is quite dramatic, especially in relation to the size of the premium. All right. So theta is the thief in the night that comes and steals our premium, right? That's an easy way to figure it out. And Vega is just volatility. It's the measure of change in volatility. Vega is volatility. Somebody just wanted to have a great word for, Vega. Something we haven't used a whole lot of is rho. And the way to remember that one is rho is just the interest rate. It's basically, it's going to impact our premiums based on the treasuries. Okay. So we don't really have to worry about that so much right now because interest rates are so low. But, once interest rates get up into the, double digits, then that really will impact this, because then you have to make a decision whether or not the secure treasuries is going to be more valuable than what our premiums will be. So that's something that comes into play much later on. But Vega is basically the rate of change in volatility, which is over here. So Vega, we can kind of look at it over here. So when this increases, we can talk about it when this volatility increases by 1 percentage point. So it goes from 34.38. So 34.38. Now we're at 35.38. Well, all of these premiums are going to increase by that corresponding volatility down here. So all of these will impact. So if this went from 34.38 to 35.38, these premiums are going to increase by 3 cents. So then we would have 98 cents bid at $1.01. Okay. Now, if we had it as a decrease, if it decreased by 1 percentage point, and we went from 34.38 to 33.38, this also goes with the puts as well, you guys. I'm not just cherry picking, but if the volatility is going to be negative then, right? If we go down by 1%, then our premiums would go down by that 3 cents. So we'd be at 92 cents bid at 95 cents, okay? And that's all else being equal. This underlying hasn't changed in price. The days haven't gone by. We haven't had the theta or any of that stuff happening. We're just talking, we're narrowing this down to how volatility, Vega, and that's just volatility, impacts our premiums. All right, pretty simple. But I just wanted to make sure we were all clear of concept before we start moving on with the rest of the webinar, because this is the first one in the series, and I see there's a lot of new faces out there, and I want to welcome everybody. So make sure you kind of got those down. It's pretty simple, though, once you use those little hacks to remember them. And then we go over, and we need a market assumption, right? And our market assumption with the long stock, as well as the synthetic long stock, is going to be bullish, all right? So we want a bullish assumption in this underlying that we decide to put into our portfolio. And it's pretty simple. We're going to be buying an at-the-money call and selling that same strike. This is going to be the same strike. All right, over here. So, you know, if XYZ stock is trading at 100, then we would be wanting to buy the at-the-money 100 call. We'd buy the 100 call and we would sell the 100 put. All right, so it's going to be the same strike. We're buying the at-the-money call and we're selling the at-the-money put. This is going to perform with the same risk reward as we would see with a long position in a stock, all right? So we're going to try and build this out where we have, remember, going back to deltas, we're going to try and get this to be 100 deltas, all right? And 100 delta means for every, when we talk about this, we're talking about every dollar move down, then our every $1 move down, then if we have 100 deltas, right, our premiums would decrease by that exact dollar, all right? And for every dollar move higher, on a dollar move higher, then we are going to have our premiums increase by that dollar. So that's how we're going to build this out to be 100 deltas. That way we have an exact duplicate of what that underlying is performing like. And I've got an example of one, if I can get rid of that. So this is basically the Analyze tab on TD Ameritrade, and the purple line is the stock and the blue line is the options that I built out. Now, if you look at this, I've got the, you know, it was trading 124.36 when I screenshotted this, and I got an 87-cent credit. Well, you take the 125 and subtract the 87 cents, you can see that that underlying was, or I'm basically looking to buy this underlying. If I got an 80-cent credit, you take 125 minus that 87 cents. Well, I would be buying this underlying at 124.13, right? I'm getting it at 124.13. Well, the underlying is trading 124.36. So the beauty in the options is you can actually buy this underlying cheaper than what you could get in the open market. Last trade being 124.36. You know, I mean, it's not a ton, but it's a quarter, and that goes a long way. One thing to note right down here, you can see the deltas are 99.34. You're not always going to get exact 100. Sometimes you'll actually be able to get it to where the deltas like are 101. It's on a rare occasion, but you will see that happen as well. The deltas will adjust as this becomes more profitable, especially as we go deeper in the money. You could see it going down to maybe, you know, you might see this drop to like 98 deltas or something like that if this starts becoming really profitable. You know, at that point, though, we're probably not worried about a penny here or there, especially we've already made up 25 cents on buying this cheaper than where the underlying is getting, right? Whoops, let me get rid of that. All right, so let me just go over the risk reward. We did it a little bit here, but the risk reward, like I said, is very similar to what the stock is. Maximum profit is infinite. I mean, if a stock goes to Google status, that's going to feel very infinite. The loss is when that underlying goes to zero, just like a stock. Some options we have limited risk on this. This is basically full boat risk, just like a stock. Your risk is if it goes to zero, you bought it at 100, you would be losing that $100 altogether on the downside, and your profit potential to the upside is unlimited as well. All right, and your break even is the call strike minus the credit. If you're getting a credit, usually your call strike is higher than where the underlying is trading. Okay, so like I showed you that example, the underlying was trading 124 and change. I was doing the 125 strike. That's usually when you're going to get a credit. It doesn't really matter if you're getting it for a credit or a debit. You're basically going to have the same margins. And if I would have done the 124 calls, I would have been doing it for a debit and had to add that in. Okay, so that is basically the same as what we are looking at for an underlying, basically pricing it in the same as where we were for the underlying, I should say. All right. Just try, there we go. All right. So we talked about the risk reward. It's the same as long stock. Now you're going to be able to, with options, use 50 to 75% less capital. And I say 75, if you're trading in a margin account, it's basically going to be the 50%. If you are doing this at a discount broker where you go in and you are buying stock on a daily basis, they're making you put up full boat for it. And this strategy will cost you about 75% less. Now, let's go back to our example of that Procter & Gamble, right? Now, this is that screenshot of it, and you can see the buying power effect in a portfolio with a one lot on a $125 stock-ish, that it is $3,003, okay? But if I were to throw it in as just buying the stock, you can see that the buying the stock is $6,222. That's just buying 100 Procter & Gamble at $124.42. Well, with this one, you can see that it is half as much as if you did it on a margin account. Sorry, I covered up my marker there. But you can see that it is less than that by half. So that's where I'm talking about the 50% less. If you were to buy this as just a stock, then you would have to put up the full amount of the $12,444 for 100 of the Procter & Gamble. And that's where I came up with that 75% less. No questions so far, right? I feel like I'm moving pretty fast with no questions coming up. I don't see any. All right, good enough. Well, if you are using less capital, if we're using less capital on this trade, then we are going to have, sorry, I got a little ahead of myself because I forgot to get back to my pen here. I tried to draw. If you're using less capital for the same amount of upside or downside for that matter, that means your return on capital is much higher. A lot of people like to use that as a metric, especially when they're talking options about it. It's a vanity metric really, but it is something a lot of people keep an eye on, and it's great, especially when you're newer to options trading. That return on capital is pretty amazing when you start really looking at that. All right, so your return on capital is much higher because you're using less capital to get the same amount of return. All right, pretty simple there. All right, so this is great for oversold stocks. Maybe Boeing. If you guys think that Boeing is overdone with all the bad news that's out, that would be a good opportunity. If somebody has good news coming out and you think that the momentum is going to carry us with that bullish assumption, then it's great for that as well. Anytime you would want to go out and buy a stock, then that is what we would be looking to get involved with the synthetic. Don't go out there necessarily and just buy that. Use less capital, especially if you have a smaller portfolio. That is something that is what a lot of us are dealing with. And how do you create a more diversified portfolio? That's a lot of questions I get. How can I diversify my portfolio more? Well, using synthetic longs instead of the stock is going to allow you a lot more leverage, and therefore your portfolio is going to seem a lot bigger, right? I mean, you could see that if I go out and buy a stock and it cost me $12,000 for Procter and Gamble for 100 of the underlying. Well, if I do it in options, then I can use 75% less. Well, that's, do the math. That means you got 2 or 3 other stocks you could put in that portfolio. That helps with creating a more diversified portfolio. And it's good for newer traders because, again, newer traders usually have smaller accounts. You're going to get the same upside. Remember, you're having the same downside risk as well. But if you wanted to create a portfolio and you're looking at CNBC and you see a stock that you actually want to buy, then this is an opportunity for that. James is saying BA is oversold, but no telling what's coming back or when it's coming back. You're right. Probably not the best candidate, I think. Well, James, I'm kind of in your camp. I actually looked at that today, and I don't even know if they have enough money to pay back everybody that's put money up for the planes that are getting all their orders that are getting taken away. And right now, Airbus is eating their lunch. So I'm not going to fade you on that one. This would be a good cycle reversal or oversold on a stock willing to own. Absolutely. Or if you were looking at adding something to your portfolio, maybe you already own that stock, right? And there's a correction. You love the oil stocks, because of the dividends and stuff like that. Well, and you were worried about, that position. You wanted to get some momentum in the short term. Maybe there's not that dividend you have to worry about. This could be an opportunity to dollar cost average with something like that. But all of those things come into mind. And we'll be talking about all of that stuff and how to dollar cost average in the daily market commentaries, you guys. And that's how I'm basically setting up all of these webinars as well. We'll be talking about more ways to dollar cost average as we go along. But yeah, you could definitely do this with something like that on an oversold stock, especially if you're willing to own it. You're going to have that short put. And one of the things with all of these webinars in this course, you guys, are going to be really in the assumption also that we are willing to take this stock into our account if, push comes to shove. So, make sure you're prepared for that as well. Keep dry powder on the side, meaning cash. Keep some cash available so that you can take that, and we'll show you how to lower that cost basis and stuff like that as time goes on. All right, without further ado, let's get into the nitty gritty of this. These are basically where I come up with a lot of my rules, you guys. And like I said, we're going to be buying the at the money call, selling the at the money put. They are the same strikes. All right. One thing I talk about with my rules is the right underlying. When we're looking at an XYZ stock, if you are looking at doing Airbus because you want the upside there, Airbus is not going to be a good candidate for options. All right. So that you would probably have to go out and actually get the stock. But when we're looking at any of these underlyings, my rule for this, you guys, is on a stock that is less than $100. If we are looking at a stock like Schlumberger that is less than $100, all right, then our options, I've got the wrong options up, so let me get rid of this. If we go down here, we want to look at the closest to expiration, but the ones with the most eyes. What closest to 35 days to expiration is really where this is. So we're looking at 35 days to expiration, or as close to it as we can. And really 35 days to expiration, 43 is about as close as we're going to get. And not really taking into account the weeklies, okay? You can trade these weeklies with this synthetic, but I would go with the monthlies. We're also going to be looking at different duration. But for this one, our rule for 35, we're going to be looking at the ones that are closest to 35 days to expiration because that's where the most eyeballs are. And on a stock that is less than $100, then we need it to have our bid offer to be equal to or less than 10 cents wide. And that's when we come down here and look at these options that are just out of the money on the calls and the puts. And during open market operations, this is after the close, so all our orders are getting canceled, all right? Anybody that had option orders in here, most likely, most of those people have canceled them. Some of the institutional people will leave those options in overnight. As a retail investor, I would not suggest doing that. But having said that, during open market operations, we want to look down here at these options that are just out of the money and make sure the bid to the offer is close to 10 cents to the bid offer. Now, if you have traded a lot of options and are used to, I just kind of look at it as a red light, green light. You know, you got the red light, the yellow light, and the green light. Obviously, Schlumberger is a green light, all right? If you get like a couple of them that are just outside of that, well, on a stock that's just outside of it, maybe most of them are inside 10 cents, but you get a couple of them that are maybe outside of it, you know, start looking at that as a yellow light. If they're all outside of that, you know, that's where you're going to get your red light. If it was wider than that, especially on a $35 stock, I would kind of bail on using options for that, because there's not enough eyeballs in here. And if we are directionally right and our calls go deep in the money, you can see that that rule doesn't fit. And that's because there's not a lot of people trading in there. But if it fits very well, usually there's eyeballs in here because everybody's always looking for a hedge and stuff like that. So these markets might actually be tighter than what we're actually seeing. So just know that. And an easy thing with this strategy on the pricing is we know where the underlying's trading. So when we get out of this strategy, we know where we should be able to sell it. It should be very close to where the underlying's at that time. Okay, so that's picking the right underlying. Anything that is, if it's greater than $100, if the stock is greater than $100, then basically we're just taking this decimal and moving it 3 ticks to the left. So let's say it's a $200 stock, right? Then we take the decimal and we move it 3 ticks to the left, and that would be, the rule would be equal to or less than 20 cents, all right? And that follows through. You'll see it happen on stocks that are traded a lot, especially something like even Apple, or we can look at, I can just say Google. Usually during open market operations, probably going to fail me right now. But if we move this decimal 3 ticks to the left and go 1, 2, 3, well, we're looking at $1.33-ish. I've rounded it up. Well, you come down here and these options, options here and here should be inside of $1. You can see they're about $1 wide there. They're well inside of that, and 90 cents, 60 cents and stuff. So on and so forth. So those are ones that are going to have a lot of volume and open interest. You can go over and look at the volume and open interest, click on that to make sure there's a lot of eyeballs on there by doing your drop down and making sure there's a lot of participation going on. And you can see Google has a lot of participation on any given day. But I'm sorry, that is, we should be looking at you can see the volume and open interest is much better on the ones that I said are closest to 45 days to expiration as well. So a lot of these people have had options on in the December contract are now rolling out to the January. So my rule should be, although I was pointing at some of those other ones, making sure that it fits that rule on the closest to 35 days to expiration, all right, on the tight bid ask. All right. And then we move over to picking the right environment. Well, with this one, I usually talk about volatility, all right? Well, with this one thing, you can do this in any implied volatility percent environment. So we're usually talking about ID percent, and I'll go into detail about this. But we're looking at mid-range, you know, somewhere, you know, the 30s to 50 ID percent is what I'm usually looking at for this, all right? The reason why is because there's better strategies above 50 and better strategies when it goes below 50. or below 30, I should say. So that's usually the sweet spot. But, you know, if you have an underlying, you have a bullish assumption in it, you can do it with any volatility. And why? Why does this one not fit that rule? It's because if we can take a look at our platform here again in the option montage, and go back over to the volume and Vega and all of that. Remember, I talked about this volatility. Vega affects the volatility. Let's look at something that's a little bit more down to earth. Let's just look at Facebook, even though it's still pricey. But so if we were going to be doing the at the monies, we're looking at the 200 strikes. So we would be looking at these strikes right here, but way out in time. I'm going to be going, you know, 200 days out once we get to that. But volatility is still going to be relatively the same. So if we look at the volatility right here and then come over here and look at these corresponding volatilities, you can see that volatility is 28 there and it's 28 there. So as the volatility adjusts, our premiums are going to be offset in a sense, right? Because remember, we're buying a call and then we're selling a put. Well, that makes the selling the put will be affected opposite. You know, the positive plus the negative equals a negative. It'll make that a negative. This is a positive, so it'll be a positive. If volatility increased by that 25 to 26, these premiums are going to increase. These are going to increase as well. This increase in premium helps us. You know, the underlying hasn't changed. This premium increases by 28 cents. Well, that helps us. This premium decreases by 28 cents or increases by 28 cents. We sold that, it hurts us. So they offset, right? Does that make sense? This premium is going to increase, that helps us. This premium is going to increase, that hurts us. But it's still 28 cents. You're getting an increase of 28 cents, an increase of 28 cents. So those are offsetting, okay? So we can't, we're basically, we're negating how volatility, and you can see that still holds true way deep into the money or out of the money in the case with the puts. So we're going to be able to offset it. I just think that there are better strategies and better times to do different strategies for really high implied volatility percent or really low implied volatility percent. And basically what we're looking at for that is I have implied volatility as a chart over here, as you can see. And what you do is you take the current, which is 25. We need 3 data points. 25, the high, which is 57, or yeah, let's call it 57. 25, 57, and the low is 20. So basically our, if we wanted to come up with IV percent, all right, we take the current IV minus the low IV and take that sum and divide it by the high IV minus the low IV. Hopefully you guys can see all of that. Low IV, sorry. All right, so ultimately we had 25 minus the low, which was 20. We take that sum and divide it by the high, which I think what I said was 57, minus the low, which is 20. So we've got 5 divided by 37. So 37 goes into 50, and we're going to basically come up with like 1 point, what is that, 1.0 something with my math. So about 10%. You know, I have it on the exact numbers. It's going to give you 12. But that would be in the lower range that I was speaking of, right? You know, that's below 30. We're looking somewhere in the mid-range would be the best case scenario. That if you don't have Thinkorswim or you don't have that IV percent on your platform, then, you know, you can figure it out by just ballparking it in a sense as well. You know, if it's middle of the road, you would be able to figure that out as well. You know, if you had something that had high implied volatility at 100%, you know, something mid-range, you could look at and say, you know, you can ballpark it right here. That's pretty close to mid-range. That would be a good middle of the road kind of idea, somewhere in the 30s, you can kind of eyeball that as well. It doesn't have to be exact. We're offsetting it, so we're good to go. All right. So, but in later webinars, when we're talking about that environment, that implied volatility percent is a main driver in determining our strategy. Here, we're able to offset it. All right, the duration. We want, we're going to be able to offset a lot of this stuff, because we're doing the at the monies, and the theta decay isn't going to really hurt us, right? Usually we're talking about theta decay is going to affect us. This thief, it's going to hurt us in our long call, but it's going to help us in our short put, right? So they're going to pretty much offset. So really all of this doesn't mean anything to us, but why not give us the time to be right? All right. So we want enough time to be right on the duration, and the strikes. Like I said, the thing with this is we want to be as close to a delta of 100. Or 100 delta, okay? So we're going to try and build this out so we're close to that. If we're doing the at the monies, you guys, it is most likely going to be just that. But the difference is going to be in the, maybe dollar strikes. You might have the in the money ones that's, off by, it's a 99 delta, but the ones that are just at the money or out of the money on the call side could be like 100 or 101 deltas. So we're going to try and build that out so that our strikes equal 100 deltas, so that we are directly, then it's just like the long stock, right? I think I got everything I wanted to say there. All right, and our exit strategy. Now, I don't know what you guys usually, how you get out of a long stock. When do you get out of a long stock? Well, for me, I'm going to get out of this stock at some point in time. I'm not looking to carry anything for 5-10 years, okay? If you are looking to carry this stock for 5 or 10 years, then this might not be the strategy to do. It probably would be go out there and buy the stock, because then you're going to actually get a dividend. One of the bad things with this is, the negative is you don't get a dividend, all right? We're not going to get a dividend. We will have dividend risk because our calls, well, actually we won't. They're going to offset because we got the calls and the puts. I don't know why I started saying that. But the stock will, actually we will, because the underlying will drop by the amount of dividend on a perfect world. That doesn't always happen. Sometimes the stock leaps on a dividend. So we will have that dividend risk, because on the ex-dividend date, the stock is supposed to drop by the amount of that dividend. Doesn't always happen. Sometimes, like I said, you'll see a big spike, and sometimes it actually drops a little bit more than what the dividend is. And the reason for that is because people are getting paid out. All right. All right. So what I usually do, and when I'm going through this, you guys, I go through and I make sure I check off all of these rules. Does it fit my rule for being equal to or less than, 10 cents wide, or I move the decimal? Does it figure that out? The right environment, we don't necessarily have to work out, but I would write it down. What was the IV percent for XYZ equaled, 53, okay? And then the duration, I picked 197 days to expiration. I write all this stuff down. Why? Because then you have the data to go back and look at it. It also will keep you mechanical. I would say, I got it out to 99.93 deltas, something like that, all right? Exit strategy. This is the most important one to write down, you guys, because this is where we stay mechanical. And one thing that I learned from psychology to trading, I said my psychology degree was, even though it wasn't my major, was more important to me than my financial degree in trading, because it really, we're tied to money. Money is emotional. We want to strip out that emotional aspect of this. And one of the key things to do is write all this stuff down so you stay mechanical in your exit strategy. If you pick the stock was going like this and you said, all right, right there is where I'm getting out. Well, write that out. when it's trading 147.35, I'm out. Okay. However you come up with that. I will usually look at something like a Fibonacci for me, a value area high. If you guys watch the daily market commentaries that go into, I like to use that blue side of my charts as, support and resistance as well as Fibonacci. But another good thing to look at would be saying, okay, if it goes up to that 16 delta, then that's where I'm getting out. That is a highly unlikely occurrence. So if it gets there during the life of my options, then I'm going to look to get out. All right, so right now I want to pull up the platform. Let's go through a couple of examples as we would walk through it. A lot of you guys are new, so what I usually say at this time is, throw in the questions box a couple of stocks that you guys are bullish in, and we'll go through it on the platform and see if that is something that is a good opportunity for us. All right. So 5 guys, or 5 below. I thought they were like 5.5 below now, or almost 10 below. All right. So bullish in, 5 below. So let's go over to the platform. 5 below is a $123 stock. We want to look at those closest 35 days to expiration. And we are looking at 30 cents wide, 20 cents wide. So to me, we should be looking at 12 cents wide. It could be much wider now because of the after the close. Some of these are 15 cents wide. I would definitely be saying this is a yellow light for sure. And might pass on this. One thing we can do though, they are a little bit wider, so we get a pretty good idea as it's trading 123.67. So Kurdic, am I saying that right? So we want to buy the call, right? And we want to sell the put. Well, one thing we can do to check to see about the pricing is to make sure I get an $1.05 credit. 125 minus the 105 gives me 123.95, right? So 123.95. I'm paying a little bit more. So because that option pricing is so wide, it's giving me the mid-market. I might start saying, you know what, I need more of a credit and I need to get it down to somewhere in between this bid offer, right? So increase what your credit is, which means you're lowering where you're paying for it. So right here, I'd be looking at 123.70, right? So if you're looking at something like this and you're newer to options trading, the easiest thing here to do, right? We said, where is our break even? Well, our break even is where we are actually buying this. And if this underlying is trading 123 in the mid market, let's just say is 123.70 is where I want to buy that kind of mid market. Well, if I'm looking at the 125 strikes and I subtract this $1.30 from it, well, then I'm looking at $123.70. So on wider markets on something like this, just make sure you're not paying a lot more than where the underlying is trading. You're not always going to be able to avoid it. A lot of times you're going to be able to buy it below, but you're not always going to be able to avoid it. I wouldn't pay up too much. You might go up to $1.20 credit where, you're paying 123.80. Because who's to say in the market that I would be able to pay less than where the offer is, right? So just I wouldn't pay too much through that offer because then you're giving somebody else a great edge. An option trader is going to be selling something against that, and it's called arbitrage, taking advantage of it. So don't give up too much arbitrage. But not buying 43 days out. Right, Banu, you are on top of it. Thank you. I want to go about as far as I can away. I usually like to go with the quarterlies. They usually get a lot more. But same thing. Thank you, Banu, for that. 50. One thing I want to do here is go again, buy the call, sell the put. Make that a one lot just so we can compare it to the platform there. And again, we're going to be paying a lot more for this 125 minus the we're going to be paying a little bit more. So I fixed that credit because it's getting a little bit wider. All right. Just know that if you're doing this, you'll probably be able to get it very close to where the underlying is trading. I'll probably have to go to about $1.20 and put it in there because that makes it inside of where this underlying is going. The next thing we do is we're buying the call. So we're buying the call. So we're buying a 54 delta. So we're getting long 54 deltas, right? And delta over here for the puts is a negative, but we're selling the put. We're selling this put. So a negative plus a negative equals a positive. So now we're getting a positive 46 deltas, which gives us a total of 100 deltas. All right. So that's how you figure out your deltas. You're buying these deltas, right? Because we're getting long the call. So long the call means we're buying those deltas. Well, we're selling the puts and we're selling a negative delta, which a negative plus a negative equals positive. All right. So we're positive 46 deltas. That's how I'm coming up with that. All right. So somebody else threw out gold. Let's look at gold. GLD. Again, we want to look at the options. 35 days to expiration and make sure it fits my rule. Gold moved 3 ticks to the left, 14 cents. Gold, this ETF easily will fit that rule. We don't necessarily have to worry about implied volatility percent, but it is, it's relatively mid-range or inside of that rule that I was talking about. ETFs usually have much lower implied volatility percent. You can see they have a tendency to spike, but will come back down. This was a very volatile time in GLD, obviously. That might be something we might not see in a long time, but we can offset it. So we don't have to worry too much about that rule. Now, we figured out if it's the days to expiration, June is a good one because it's a quarterly. There's going to be more eyeballs in there. So now we're going to go to look at the monies. It's trading 139 even, so that makes that choice pretty easy. We're going to go with the 139s, which we're buying the 139s and then selling the 139s. You're going to see here, we're actually over our deltas, right? I got on this side, I got plus 56 deltas. So I'm plus 56. And then I'm selling these puts, selling a negative equals a positive 45. So we're actually getting 101 deltas. So that works out pretty nicely. Where is this in relation to our underlying? Subtract the 122 from the 139. That gives us 137.82, right? 137.82. Did I do that math right? Oh, I got to add it to it. Sorry. I got to add it because it's a debit. So it's a 140.22. So I would try and decrease this a little bit. And a lot of times you are going to have to pay a little bit more than where the underlying is, especially 200 days out. Inside of 100, you might be able to get away with it a little bit. But try and get that as close to even as you can. That's a pretty steep debit for that. Must have there's a lot of call skew in gold right now. Very bullish. So a lot of push to the strikes at the 139 should be actually 50-50 delta, right? That's a lot of call skew going on. So basically these calls are all pumped up with premium, which is causing this to really get thrown off. That's a strange one. Let's look at somebody threw out Procter & Gamble. Oh, I got my thing still on. Procter & Gamble. Come on, guys. Come off. Procter & Gamble. There we go. Procter & Gamble. Look at the charts. Probably bullish in this. This has a good chart. It likes to rally. I mean, I don't think Procter & Gamble's going out of business anytime soon after after all this time. So we want to make sure that it fits the rule on the 43 days to expiration. Move the decimal 3 ticks to the left. We're looking at 12 cents. So during open market operations, we should see this as 12 cents wide. You can see obviously orders are getting canceled, but usually you're going to see Procter & Gamble well inside of 10 cents even. But after the close, we're not getting that. Just make sure during the open market operations, it fits that rule. And another thing, our pricing is getting a little funky here as well because it's after the close, and who's going to keep options in this far out. All right, we're looking at 125 handle. So I'm going to buy the 125s, sell the 125s. Oh, Procter & Gamble is the one I used in the previous example. Anyway, you can see we're adding 51 plus the 48. We're getting about 99 deltas in this. We subtract this 70 cents credit from the 125. We're getting basically this at 124.30. So in this example, 124.30. Why aren't you letting me draw? You don't like my finger touching it? 124.30 on this. So this is an example when they're tighter anyway. Some of those other ones we're getting a little wide, but we get a 70 cent credit, right? We subtract that. We're getting this one cheaper. Wait, why did you go to the June, which is 190 days away? Because I want to go as far away as I can to give myself, if I'm going to put this in as a long term, I'm going to try and go as far long term as I can. The rule, I could have done the April as well. If you're only planning on being in this for a shorter duration of time, maybe you're thinking, whatever your assumption is, maybe you're thinking you're just looking for it to go to the 130s, right? If I do these, if I'm going to buy this and then sell these if I'm going to buy the 125s and sell the 125s, I'm still getting a 50 cent credit. But one thing to note is, why not go as far out as I can? One thing, you go 300 days out, the markets are going to be wide and you might not get hit on it. But go out as far as you can, because my buying power effect, $3,000, is going to be about the same as my buying power effect way out here. If I buy these and then sell those, right? If I go and look at my buying power effect, it's off a little bit, but for the most part, we're talking about the same thing. Our buying power effect is about the same. So I would rather give myself enough room to be right and move further out in time. Did I answer your question? On one of those examples, Banu caught me because I did start playing around with those 43 days to expiration. But at the end of the day, why not go as far out as you can? 400 days, 700 days, there are going to be wide markets. You might put this in at 124.50 and never get hit because nobody's keeping an eye on it. If you pay up through the offer, you most likely will get hit on those, you guys, because there's arbitrage there. Somebody's going to take that option away from you. He's going to sell you that short, that synthetic long, and then he's going to go in and buy the underlying, and he's going to create arbitrage. He's going to sell it for those couple of pennies. Don't allow that to happen. If you pay over this offer on this synthetic long, just know you're giving somebody the opportunity to go out there, sell you that long at, if you did this and you were doing it for 125, why aren't you, my pen? If you built this out to where you were paying 125, right? Somebody's going to sell you this and then just go out there and make 35 cents on you. Somebody would do that. That's called arbitrage. So don't allow yourself to get into that. Make sure you are falling somewhere in between at least. And in this case, with this one, I'm buying it at below market value. So one thing with the option pricing, that I said with the bid offer being a little bit wide and knowing where the right pricing is. I don't want to get into, Black Scholes and all of that, but knowing where the right price is will not necessarily be something you have to know on this. You just know, if I get all this built together, my break even on the stock is really where I'm getting long that stock. And just make sure your break even isn't higher than where the offer is. Ed's asking, can you sell calls against this? Absolutely you can. And during the daily market commentaries, I'm going to be talking about that. I'm also going to be talking about that with other strategies as well, where we're going to be building out like a poor man's covered calls, stuff like that, where we will have other strategies where we can lower our basis even further. Do these in the leaps where you're going really far out. And then I wouldn't sell the call further out than where we are building this strategy, though. Make sure, we would be selling a call inside of 35, as close to 35 days to expiration as we can. And I'll go into the rules of all of that in a different webinar, though, but I don't have time to go into doing that now, though. Sorry. Does earnings affect this? Yes. As I spoke before, if we have an earnings event, it can. It's not necessarily going to affect this, but what we're going to be looking at is, for instance, on this dividend date, 70 cents, the stock is supposed to drop by 70 cents on the ex-dividend date, 75 cents, all right? It does, so our underlying, if we bought it at 124 and the next day was the ex-dividend date of 70 cents, then our underlying would be expected to drop by 70 cents on that day. But you can see here, it didn't really drop by, maybe it did, it was close. I'd have to do all the math on it. But it doesn't always drop by that dividend. Some days it will actually rally on that dividend date. It seems like Procter & Gamble has a tendency to do it. But, for instance, if I looked at Apple, I know Apple doesn't. Apple doesn't always drop the price on the ex-dividend date. You can see here on its ex-dividend date of the 9th, it may have there, but it doesn't always. I'm not finding a very good example of one. On the 10th, that one dropped a lot more. But it doesn't always, believe me, it doesn't. This one it didn't. It actually rallied on the ex-dividend date. But on this ex-dividend date, it looks like it popped. So you can see that sometimes that dividend doesn't necessarily affect the drop so much. Okay. The reason is on that date, everybody that buys it on that date isn't going to get that dividend. So everybody before got the dividend, everybody after should be compensated for that. And in this case, since we aren't getting a dividend, it will quite possibly negatively affect us. And a downside to this, yes, good question. You're asking all the right questions here, Banu. Earnings, you will, because we're so long in the future, we are going to have to go through earnings just like we would with a stock. So we'll talk about different ways in the daily market commentaries, what we're doing to kind of offset some of those risks. But yes, we are just like a stock. If you owned a stock for 150 days, you're going to be going through several earnings cycles. So this is something we are very long-term bullish. Something I was going to be looking at is Disney. So I think Disney's had a bit of it got a bit of a sell-off off of the streaming news and stuff like that, a big pop. I don't think that Disney is going anywhere anytime soon. I think that there's going to be a lot of people buying into their streaming services. So, I think that Disney is going to start moving higher as well. So I'm going to be looking at Procter & Gamble and Disney tomorrow during the daily market commentaries and implementing one of those two, whichever one looks better tomorrow. So keep your eyes out for that as well. But yes, we will have to go through earnings and dividend cycles with this one. All right. But other than that, it's just like a stock. We're going to be doing it. We won't get that dividend either. So that is something that if you rely on, then, you know, doing a synthetic long is probably not necessarily the thing to do as well. All right, so without further ado, you guys, I'm going to throw this out there. This is our trading course. I see there's a lot of new faces out there. For $297, we're giving bargain basement. And that's because we're starting this course up. These are some great different options courses. You know, this would take you, I mean, there's 10 hours in each one of these, at least 10 courses, but Volatility Crush is going to help you guys sleep at night. I talk about all of the things that go in and around that. The link somebody's asking about is, I'll throw it over there in the chat window. Whoops. The chat window has the link in there now. Send that out to all you guys. So you can just click on that link. It's a hot link. It should bring up a web page that you can take advantage of this. But this one's going to help you sleep at night. The Volatility Crush, understanding that. Floor Trader Hacks, I talked about that. You know, there's like 6 things that Delta tells you. There's all kinds of different hacks to help you remember some of the option nuances and things of that nature, things that we traded on the floor, way we looked at different things to help you with your day-to-day process. Options Basics, this is a great one that's going to give you a refined look at options and how you trade those, calculating costs, all of that stuff, going into detail. You know, in this one, we didn't have to worry about calculating the cost of an option because we figured it out by, you know, where the underlying is trading. All of those things and more are going to be in the Option Basics. But, you know, you got one of them is an easy way to figure it out whether your pricing is right or not. All right. And trading with dividends and stock splits, all of those things and how you can take advantage of that stuff, and setting up your option screens like I do, your trading market profile, which I use a lot of. I think that's probably one of the most important things to look at. It's really the psychology of the market showing up in the market profile. So for $297, you guys can't beat it. Give yourself an early Christmas present. Because this one is something you guys should all have in your wheelhouse. You have all the time in the world to go over all of these once you've gotten into this course. And basically, once you watch, say, this webinar, it checks it off so that if you're skipping around and moving down to this one, you can check it off. And maybe you don't want to watch the history of options right now, but when you're bored, that's a really fun one. Make you sound really smart at different parties. You can even be talking to an options trader that's been in the business for 25 years and he won't know what you're talking about. Show him up. Anyway, for $297, it is a great deal. It's one of the best packages we have, and we aren't going to be offering that much longer. So take advantage of it. We're only throwing that out there because it's the beginning of this course, and you should take advantage. If you don't have this right now live, right here is the course. You can pause and punch that into your URL to take advantage of it. You know, I teach like this in all of these different webinars to try and make it a little bit easier so that you guys can wrap your brain around it rather than just going online and looking at Investopedia. They're not going to give you strike locations and the type of duration and all of those things and why you can go further out in time and still take advantage of this type of strategy, all of that stuff. Specific rules that I have with those keys to success. All right. So I just want to thank you guys all. Later webinars, I'll be drilling down on different option components when and where I find those appropriate. Also, here's a link, Pro Trader Strategies as well. If you're watching this on tape delay, you're going to have to hit that. And just want to thank you guys all for participating. And if you have any questions, comments, or you have a video you want me to do something on that you haven't seen, reach out to us. Let us know at trading@protraderstrategies.com. All right. Thank you guys all. Appreciate it. Like I said, the link is over there. The hot link for you guys watching this live is over there in the chat window. And, you know, take advantage of the options trading special. All right. Take care. I hope everybody has a tremendous weekend. Thank you, Ted. Another tremendous webinar. Appreciate the kind words everybody's throwing out there for me. And that's all I got for you, other than if you can't take that, take it easy. Take care, y'all.